Digital Realty stock, ticker symbol DLR. Is this the best dividend REIT to buy right now? DLR stock is down almost 29% year to date, which is quite a lot, and it has come up and down a lot as well. The S&P 500 is down 15% year to date, so that's quite a difference with DLR. But one of the reasons why people love DLR is because of the dividends. And I get why. Almost 4% dividend yield and 16 years of dividend growth. And with the stock price coming down big time, the dividend yield will go up. But does this mean that DLR stock is a buy? In this video I'm going to show you real quickly what DLR does, the historical returns, the fundamental analysis, dividends, some competitors, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Digital Realty Trust do? Digital Realty owns and operates nearly 300 data centers worldwide. It has more than 35 million rentable square feet across 5 continents. If we check the latest quarterly report, we get this fancy sheet, where they put in a few interesting things about the company. More than 4,000 global customers and 290 data centers. Next to that, they are the 7th largest publicly traded US REIT, and were added to the S&P 500 in 2016. They also have a B investment grade rating, which is pretty okay, not that special to be honest. The demand for data centers is of course very high and will continue to grow from here. The compound annual growth rate around the world for the data centers demand is very attractive for companies like DLR. And DLR is all over the place. North America represents 58%, EMEA represents 27%, APAC 10%, and Latin America is at 5%. To me, the FFO is very important for a REIT, and there are happening some interesting things here. The FFO available was decreasing year over year in the latest quarterly report, but the CFFO was increasing, which led to an increase of 1.45 to 1.72. And this easily covers the dividends of 1.22 in the upcoming quarter, so this comforts me a lot. But keep in mind that the rental revenues was decreasing year over year. It went from 887 to 863, while the expenses increases from 350 to 358, meaning a lower net operating income and in the end a lower cash net operating income. It decreased from 540 to 510, so this is something to keep your eye on. The last thing that I want to discuss is the outlook for the rest of the year. They lowered the outlook in FFO per share from a range of 6.95 to 7.05 to the new range of 6.75 to 6.85, which still covers the dividends of 4.88 very well, so that's the good part. And now that we know more about DLR, it's time to check the historical results to see what happened there. I decided to include the S&P 500 as a benchmark, and also add their major competitors, which are REIT, BXP and SPG. On the 5-year chart we see that the S&P 500 did beat all the stocks in this list quite easily. DLR had a 21% return including dividends, while the S&P 500 is at 80% return. REIT had a 52% return, BXP a minus 15% return, and the SPG a minus 15% as well. So you were better off owning the S&P 500 in the past 5 years. On the 1-year chart we see that DLR returned a minus 19%, while the S&P 500 is at minus 8%. REIT and BXP are both at a minus 20%, and SPG is at minus 16%. So again, you were better off owning the S&P 500. On the 6-month chart we see a minus 7% return for DLR, while the S&P 500 is at minus 4%. REIT is at minus 16% and BXP is at minus 29%. SPG is at minus 90%. So again, you were better off owning the S&P 500. On the 1-month chart we still see only negative returns. DLR is at minus 4% return, the S&P 500 at minus 1%, REIT is at minus 1.98%, and BXP is the first stock in this list to beat the S&P 500 with a minus 0.4%. So still not very good, but it did better than the S&P 500. SPG is at minus 2%. To be honest, based on what we see here, it's quite obvious that you were better off owning an S&P 500 ETF. All these stocks were hammered down a lot. But what about the future of DLR stock? After the big drop, it could be a potential interesting buy. Let's check the fundamentals of the stock to see if DLR is a buy. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe, and in return you receive similar analysis to this one every week. Let's continue by diving into the fundamentals. DLR is a 35 billion market cap company with a PE ratio of 26, which could mean that you pay a premium for the stock. But hold your horses. DLR is a REIT, meaning a PE ratio might not be the most accurate way to value the company. So I'm going to use the price to FFO instead of the price to earnings. Right now, DLR has a price to FFO of 20, meaning it's around their fair valuation, according to this metric. Later in the video, I'll give you my 3 price targets to see at which price I might buy the stock, so make sure to watch until the end. Next up is revenue. DLR has a 4.5 billion trailing 12-month revenue. And in this graph we see that the revenue went up quite nice and steady in the most recent quarters. We see that revenue starts to slow down a little bit, and this is something what I think is very interesting. In this graph we see the revenue growth per quarter year over year. And in a way it's kind of consistent. Around every 2 years revenue starts to slow down, and then it will go up big time again. So this might be a pattern that's very common for this company. I'm not saying that in the coming quarters revenue will go up big time again, but it seems to be a very interesting pattern. Net income is at 1.3 billion, which gives us a profit margin of 29.7%, which is significantly higher than the 5-year average. So I really like that a lot. But if we check the income statement to see why profit margin increased that much, we see that other income and expenses is at 993 million, so let's call it a billion. And this is a big increase versus the previous years. So they probably sold off a division, asset, or had gains from foreign exchange transactions, which kind of makes sense with the exchange movements we had lately. So this big increase in profit margin is probably a one-time hit and will lower eventually to normal levels again. Next up are the return on assets, which are at 4.2%. Return on equity is at 7.6%, and the most important number here, the return on invested capital, is at 4.9%, which is slightly above the 5-year average of 4.6%. So I really like that a lot. Usually I prefer companies with numbers above 10%, but since DLR is a REIT, it's a bit different, since REITs have lower numbers here in general. So I don't mind being below the 10% minimum. And to be honest, it's looking quite good for a REIT compared to some others. Another typical thing for REITs are higher debts compared to the cash position. DLR has 99 million in total cash. Operating cash flow is at 1.6 billion and leverage free cash flow is at 1.8 billion. Companies use debt to grow the business, and REITs have higher debts in general, so this is something to keep in mind. Right now, total debt is at 15 billion, which is quite a lot compared to the cash position, so this is something to keep your eye on. And to me, it's very important that DLR has an increase in free cash flow, since this is used to pay down debt of course, but also to buy back shares, do acquisitions and all other things. And this is something that I really like about DLR. For a REIT, it's going up quite nice and steady, so this comforts me a lot. Next up are the dividends of DLR. Right now, dividend yield is at 3.98% and they pay you a 4.88 annually or 1.22 quarterly per share. Payout ratio isn't correctly displayed here since DLR is a REIT. We need to use the FFO here. We have an FFO of $1.72 and dividend is at 1.22, meaning payout ratio is at 70%, which is pretty common for a REIT, so it looks good to me. The 5-year growth rate is at 5.6%, which is also pretty good for a REIT, since dividend yield is already at 4%. On top of that, DLR increased the dividends for 16 years in a row, which is very impressive. Overall, dividends look really good to me. Next up are the fundamentals of DLR versus their major competitors. I decided to include ARE, BXP and SPG. Both DLR and SPG are the biggest companies in terms of market cap. ARE has the highest revenue growth year over year and also the highest revenue compound annual growth rate, but DLR is at the second spot. Net income growth is the highest at DLR, but this might be a bit diluting because of the other net income increase. Free cash flow margin is growing the highest at ARE again. Gross margin is the highest at SPG, and so is the net income margin. Return on equity is also the highest at SPG, so is the return on total capital. All companies have a lot of debt compared to the cash position, so to me, there's no winner here. And now the most important part, to most people, the dividends. SPG has the highest dividend yield, but ARE has the highest dividend growth rate. DLR has the most consecutive years of dividend growth. I think there's no big winner here. Overall, we see some mixed results. DLR was in most cases on the second spot or third spot. But does this mean that DLR stock is a buy at current prices? Let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get my 3 price targets, starting off with revenue growth. I expect the revenue to slow down a bit from the 5 and 10 year average, since it will be harder to grow the business in double digits when you become bigger and bigger. So I'm filling in 4, 6 and 8%. The profit margin, I'm aiming for the 5 and 10 year average, since we saw that the current profit margin is diluting because of other incomes. So I'm filling in 17, 18 and 19%. Free cash flow margin, I'm aiming for 40, 41 and 42%. PE ratio, I'm filling in 20, and the price to free cash flow, I'm filling in 18, 90 and 20. My desired annual return is 12.5%, since I can get an easy 10% average return with owning an ETF. Right now, DLR is at $124 a share. I hit analyzed and we only see one green number. But first I want to say that I'm not focusing on the multiple of earning value, since this is a REIT. So to me, only the discounted cash flow value matters right now. We have a low price target of 94, a mid price target of 115 and a high price target of 141. If you believe these high numbers, then DLR stock is a buy. To me, the mid to high range is the most justified here, so 150 to 141. My final conclusion on the stock is that I really like the business, and most parts of the stock as well. The valuation isn't too bad and dividends are really good. I like the fact that free cash flow is growing, but there are some downsides as well. Profit margin isn't really that high, to be honest, and to me that's very important with a REIT. For now I'm aiming for the 115 to 141 price targets, and DLR sitting at 124. I think I will wait for the next earnings to see what happens with the margins and also the outlook. So I do think this stock is very interesting from a value and dividend perspective, but for now I'm waiting for the next results and hopefully the stock will come down so I can enter at lower prices. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I'd really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.